about C&Q because I just have a brief comment on them putting out their guidance and budget last week, which was no surprise.
Was it a positive
Oh,
guidance?
sort of a neutral. I mean, the stock really didn't react either way on Friday. Um, their production growth is going to really all be acquisitions that they've made here, but they laid out their typical program where they're going to be aggressive on share buybacks, and they raised the dividend each of the last 25 years. They raised it twice last year. So their last dividend raise was in October. So we don't get a dividend raise when they report fourth quarter. We could, but we'll get a dividend raise at some point during the year. It could be
I am long that. During the fourth quarter, I really restructured my portfolio to add energy. It was painful in December, but feeling less painful today.
Yeah, that's why when C&Q dipped below 30 back in December, it was just like pound the table on it, back up the truck. The gas names have been a little bit more difficult just because you knew it was going to get cold at some point. They were going to pop on the cold weather, and then we'll see once this cold weather passes what happens.
Yeah, and I had a nice run in Antero AR. That's been a nice one. And I bought that well.
Yeah, all these gas stocks have been a great trade. Maybe I should have been more aggressive in trying to trade them because you knew at some point you're going to get a cold snap. Even if the winter's warm, at some point you're going to get a week or two of super cold weather.
That's a hard call, though.
Yeah, and things are going to spike when that happens. So.
Yeah. And, some of the short-term traders I talk to think this whole, not necessarily gas, but WTI crude, the whole thing is more of a short squeeze because people were caught offside.
Yeah, I think some of it is a short squeeze. What's going to be interesting here, though, is that when the oil price is up, this is part of the argument that inflation's not tempering off. And once Trump takes office in a week, what's he going to do to get inflation under control? And, part of the headlines this morning was that there are new sanctions on Russia that provided further support to oil prices. So, what's Trump going to do? Is he going to come in and maybe say we're going to lift sanctions if you stop fighting with Ukraine? And I don't know. It's going to be interesting. There's a lot of things to be decided here starting in 1 week.
Yeah. And sequencing what he can accomplish is going to be key because if he gets through or starts with some of his more inflationary policies prior to, the pro-growth policies, we could have a real weakness in this market. I mean, I've been expecting January to be ugly to begin with.
Yeah.
I've gotten very bearish about January. But, do we pull out of it, before, June? And I think that gets back to sequencing things. I mean, my industry, the banking industry, had this huge run in November related to the whole deregulatory theme. But there was a Supreme Court ruling yesterday that sort of put a roadblock in Trump's ability to replace some of the heads of agencies. And that is going to be a difficult situation for some agencies, not all, but for some agencies.
Yeah.
For example, clearly cannot replace Powell at the Fed. That's clear now.
Yeah. Well, there's going to be a lot of time spent here initially on just all the confirmations of the cabinet nominees.
Yeah, and I had mentioned that there's this office called OGE, Office of Government Ethics. And in November, Biden placed his appointee at the top of it, a guy named Huitema. I'm not pronouncing his name correctly, Huitema. And this guy was put in place to slow all the paperwork down that is required before a confirmation hearing is possible. And so it's hard for Trump to get his appointees in place on a timely fashion. Anyway, I think we're ready to go.
Yep. Are we ready to go here, Jen? Oh, there we are. Good morning. It's Wall Street Beats. It's Monday, January 13th, 2025. We're 1 week away from a new president in the United States and a lot of change, a lot of uncertainty as to what happens beginning in 1 week. But in the meantime, I'm going to start by saying that all of our thoughts and prayers continue to be with all the people in California affected by the wildfires and the devastation there. But I'm going to turn it over to Charlie to start out this morning. I'll circle back later, some comments on energy. But Charlie, I think you had some comments with regard to these wildfires in California.
I do, and I'll end up there. I want to make two sort of macro observations very quickly. So this week we get the CPI and the PPI, and how those numbers come in is going to have some bearing on the rate structure, and rates right now is trumping pretty much everything in terms of how the market is trading. But the one observation I will make ahead of that is that for the first time since the Fed started cutting rates in September, the 2-year Treasury yield, which is around 4.39, 4.38, is trading above the Fed funds rate, which is around 4.33. The importance of that is that it suggests that the investor is no longer expecting further rate cuts by the Fed. The fact that the 2 year is trading above the Fed funds rate. Whether they're expecting rate hikes is a different story, but at the very least, the marketplace is saying we no longer expect rate cuts. So will that change when we get the CPI and the PPI this week is what remains to be seen. So it's an important observation since rates are really the one factor that's driving the markets right now. Our own expectation, we've been saying this since December, is that the 10-year will move up towards 5%. We thought breaking through 4.5% would be a real negative for the markets. Around 5%, I might be willing to buy the TLT because I think a lot of things will have been discounted in the way things trade. Anyway, let me move on to the next thing, macro thing. This Friday, we get housing starts. As anyone who's followed Wall Street Beats for a while knows, I've been on this kick that things that need to be financed are going to disappoint. And by things, I mean homes, boats, RVs, motorcycles, cars, etc. I expect housing starts to be weak. When they get reported on Friday, they're probably going to get lost in the sauce of all the earnings. But anyway, I do expect them to be weak. And that's important because that's the future cash flow of home builders is housing starts going to completions. The reason I expect it to be weak is that the inventory build for the home builders is quite high. And they need to move product off the lots, and it's going to require incentives, either mortgage buy downs or other types of incentives. So another data point that would suggest the home builders are going to continue to correct, particularly if rates trade higher. Finally, I wanted to, as Bob mentioned, end up with some comments about California. And the wildfire situation in California is still very dynamic. So it's really hard to make strong statements about what impact those fires are going to have on the loan portfolios of the big banks. We start earnings season this Wednesday with the big banks like J.P. Morgan, Citigroup, Wells Fargo, Goldman Sachs reporting earnings. And so I'm hoping that there'll be some comments, but my guess is it's too early for them to quantify the potential impact. I wrote a report over the weekend where I tried to put some parameters about the potential losses for the banking industry, and we'll see what comes out this week in terms of guidance. But let me back up and say, in general, the credit quality guidance or the credit quality metrics that are going to be reported for the fourth quarter this week are going to show very benign credit conditions. We'll have non-performing assets rising low to mid-single digits. Charge-off rates, in the fourth quarter will be sort of similar to the third quarter, which we call normalized levels. And reserve build will be minimal at worst, and we may even get some reserve reliefs. So in general, the credit quality metrics that we're going to see reported for the fourth quarter are going to be fairly benign. The question is the California fire situation sort of a tipping point in conjunction with a higher rate environment for longer, that will create stresses going forward. And we're starting to see signs of that outside of the banking industry. And I would make the argument that the bigger risks are outside the banking industry. The banking industry has actually done a fairly good job of managing their credit risks and building reserves ahead of any sort of downturn in economic activity. But we've had some of the private equity firms, some of the monoline consumer finance companies surfacing problems just here in the fourth quarter. So let me point out a few just to give you an example. Bread Financial, BFH, is a monoline credit card lender that really supports the subprime borrower, and they've raised their expected loss rates going forward. Then there is Ally Financial that last week announced a restructuring and a pullback in some of their lending, and because they're seeing rising losses in mortgages, credit cards, and their core business of autos. Then there was a small regional bank, First Interstate Bank Systems, that pre-announced on Friday that they were going to take a $49 million charge-off on a distribution company. This company had been previously recognized as a non-performing asset, but had been given forbearance in an effort to help it get back on its feet. They had set up a 26 million reserve against this, exposure, but in the end, it proved insufficient, and they're going to take a much bigger charge off than they ever anticipated. By the way, that process of forbearance is something that I think is playing out throughout the banking industry and outside the banking industry pretty aggressively. And I think it has understated some of the stresses in the system. The last thing I'll just mention very quickly is BlackRock also had a big write-off on an investment in one of their private credit, private equity portfolios last week. So we're seeing signs outside the banking system as well as inside, the banking system, that credit is not necessarily healthy, but the deterioration is, at least within the banking system, is occurring at a manageable pace. So my, trade-off of this is to endorse something that Ben Bray has said earlier, and that is to buy into some sort of credit spread widening trade. I think, if you had one trade that you had to put on this year and hold through the balance of the year and you couldn't take off, it would be that credit spread widening trade. Ben's preferred vehicle is a ETF, I believe, called SJB is the symbol. But if you look at JNK or HYG, which are some of the junk bond ETFs, you can see that they had a sharp break towards the end of December, early January. They've come back a little bit, but spreads are incredibly tight relative to any sort of historical norms, and I still see credit deterioration occurring. So let me talk a little bit about and finish with some of the individual bank exposures in California. And this is something I wrote about over the weekend. Jen, if you can put up that first chart. I went back and first of all, you should be aware that no bank gives you their loan exposure in LA specifically. So we're having to guesstimate what sort of exposure banks have. But the four banks with big exposures in LA are Bank America, JP Morgan, US Bancorp, and Wells Fargo. JP Morgan, enhanced their exposure there when they bought First Republic, and US Bancorp enhanced their exposure there when they bought Union Bank. What I can show you is how many branches they have in LA, how many branches they have in California, and then their total branch structure. And you can see that the LA branches as a percentage of total, the very far right-hand column, is roughly 5% of their total branch exposure. So the assumption I'm making in the exercise I did over the weekend and trying to understand what potential losses are in these loan portfolios was to say, okay, maybe LA loan exposures represent about 5% of total loan. So Jen, if we can go to the next table, on loan exposures. Yeah. So, there are obviously different types of loan exposures: credit cards, which are completely unsecured; auto, which may be secured or have insurance, I mean; residential mortgages, which typically does have insurance; home equity loans; a multifamily exposure. Then there's CRE, commercial real estate, and CNI. And not every bank reports these numbers, so you're not getting a total apples to apples exposure here when you look at individual banks. But you can see that California, and by the way, this is total California. This is not LA, because they clearly are not giving you LA exposure. They're giving you total California exposure. You can see that it ranges anywhere from 10 to 30% of total loans, and then LA would be some sub segment of that total exposure. And what I do in this next table is try and estimate what the loan losses will be um, in terms of the potential fallout. So I've estimated, based on the previous slide, that the Los Angeles is 5% of their total California exposure. And then I assume that the delinquencies that arise from this fire are going to be X percent. This is a table that I use to play around with the numbers, but in this particular table, I said, okay, let's assume 10% of the exposure goes delinquent. It could be as much as 40% goes delinquent, but I just started at a low number. And then you have to assume, of those that loans that go delinquent, what's your loss? And in this exercise, I assumed a loss given default of about 25%. It would not shock me if the loss given default is 40 or 50%, but I just wanted to start somewhere. Um, and the bottom line is, if at this low end, what I would call the low end, losses are going to range from a low of 250 million at U.S. Bancorp to as much as 750 million at J.P. Morgan. Relative to the total loan losses that I'm projecting for these banks in 2024, this is a very manageable number. It would increase their loan losses by roughly 10% on average. So not a problem. But if you increase the potential delinquencies to 30%, and then assume a 50% loss given default, you can start talking about numbers like 750 million of losses at U.S. Bancorp, to a billion each at Bank America or Wells Fargo, to as much as 2 billion at J.P. Morgan Chase. So, depending on what assumptions you want to make, you can get to some numbers that are going to be impactful. The one thing I would conclude with is, while the loss, potential loss, are going to impact earnings at some point here, in 2025, it's unlikely they'll be big enough to impact capital on the balance sheet. In other words, I don't think we're going to see the kind of losses that banks experienced, let's say, in the residential bust of 2007, 2008, that diluted the capital accounts. So I think the balance sheets are fairly safe, as the banks are well reserved, but the earnings are at risk from these fires. So why don't I stop there, Bob, and let you.
So add two questions. Do you think, when the banks report earnings starting this week, that they'll give some sort of guidance or commentary along the lines of what you outlined here as to what the potential losses could be?
I doubt it. They'll probably make broad sweeping statements that it's manageable, and a lot depends on how they approach it. I mean, clearly forbearance is going to be given. For example, I have a friend in LA who lost his house and his truck, and his truck had all his tools in it, and so his tools are gone. So he clearly has no truck, no tools, no business, and no cash flow to service his credit card and auto debt. And so he is probably going to be granted forbearance on the theory that there's going to be a period of rebuilding, and that he's a contracted construction guy, that his business will pick up once the rebuilding of LA starts. So there's going to be some forbearance that will delay the recognition of losses, but the banks may reserve up front in anticipation that even with forbearance, some of these loans are going to go bad. So it's very difficult for me to pinpoint where the hits are going to be taken, how much the hits are going to be. What I can say with some degree of assurity is the bank's losses, whatever you thought the bank's losses were for 25, they're going to be some magnitude higher. But I'd be surprised if they put numbers around it. I think what they'll try and do is say, we can manage it, we're well reserved type of commentary.
Okay. And the other question you had on your initial comment, I wasn't aware that the 2-year Treasury had risen above the Fed funds rate, indicating the market saying we're not going to get any rate cuts this year. I think there's only one firm on the street, I think it's Bank of America, that's come out and said that they're now forecasting no rate cuts. Do the bank stocks reflect that? Is this good or bad for the bank stocks? And do they already reflect no rate cuts if that is the scenario?
Yeah, we've seen, the banks have given back all of the rally that they had in November, which was a rally based on, tax cuts, deregulation, a pickup in M&A and IPO activity. All of that has been given back. And the group that has been the weakest has been the regional banks. And they're the ones that would suffer the most from higher interest rates. One area of exposure that the regional banks have heavy, use of is what we call cash flow interest rate swaps. And these swaps were put on in anticipation of rates going lower. And if rates don't go lower, then they're going to have huge unrealized losses in these cash flow interest rate swaps. And the regional banks have put these on in a very aggressive fashion. I've written about this and posted it on the Wall Street Beats website. And so I think the regional banks are viewed as the most vulnerable to an environment where rates remain elevated for longer. The other group that just last week started to see a little bit of weakness were the capital markets banks like Goldman Sachs. And that was on the heels of the Jefferies announcement. Jefferies announced very robust revenues in investment banking and trading. And so we're expecting that on Wednesday and Thursday, we'll see similar reports from Goldman Sachs and Morgan Stanley. The problem was Jefferies reported a disappointing bottom line. So they beat on revenues, but missed on EPS. And the reason they missed on EPS is because they had to accrue large bonuses for these investment bankers. And the analysts hadn't adjusted their models for the compensation relative to the robust revenues. And so it'll be, what I want to be careful about is Jefferies being sort of a second tier investment bank. They would hate it if I said that, but it's not a bulge bracket firm yet. They had gone on a hiring spree of hiring huge, big ticket guys out of the bulge bracket firms. Same with Evercore, Moelis, Houlihan Lokey. All these guys have been trying to beef up their talent because they've been expecting a big M&A IPO wave. But they're now faced with having to pay these guys to keep them. The bulge bracket firms may not have had to do the same sort of upgrade of talent and therefore may not face the same compensation costs, but they are going to have to, accrue higher bonuses. And so we'll see how that plays out. But we did see some weakness in Goldman Sachs and Morgan Stanley after that Jefferies report last week. Sorry, I apologize.
No, that's a lot of information. Good information. Thanks, Charlie.
Yeah.
I was just going to make a quick comment on energy. We'll be consumed with bank earnings here over the next week or two, and then we'll start getting earnings from the energy sector after that. The one company that did come out last week, first company to come out and give guidance in their budget for 2025 was Canadian Natural Resources, C&Q, which is one of our favorite oil-focused names. And it was no surprise. It was pretty much in line in sort of a neutral reaction in what they came out with. And they're going to see production growth of around 12% this year. But what I point out is all that growth is coming from pretty much acquisitions. So the organic growth is going to be flat to maybe 1 or 2%. And they've made some very smart acquisitions that's going to drive that 10 to 12% total production growth. The other thing I'd point out is that while they're looking at natural gas production being up 14%, and again, that's mostly from acquisitions. All that natural gas production is coming from liquids-rich areas. So that natural gas is getting an extra uplift from the liquids that they then strip out of the natural gas. They're not producing any pure natural gas wells otherwise, given the gas price environment. So, again, another company that's sort of holding back from ramping up due to economics, their pure natural gas production. But the last thing I'd say with CNQ is they still have on deck a very aggressive share repurchase program. So they expect that per share growth to be even higher as they allocate 60% of free cash flow after dividends to shareholders, which I think will primarily be from, again, share repurchases. There'll be a dividend increase coming at some point this year. They pointed out that they've increased their dividend every year for the past 25 years. And last year they increased it twice. Do we get a dividend increase here in a few weeks when they report fourth quarter earnings? Maybe. Typically, that's when they do increase the dividend, but they last increased the dividend at the end of October when they reported third quarter earnings. So maybe we get one now, maybe it comes later in the year, but we will get a dividend increase at some point this year in a stock that's already yielding close to 5% on the dividend, which I view as very safe. So, as oil prices continue to be strong here and hold in, CNQ continues to be one of our top picks on the oil side. So just wanted to throw that out. We'll have more commentary as other companies come out with budgets and guidance for the year, but that was the first company to really come out with their budget and guidance, which was pretty much in line, no surprises.
Hey, Bob. On the WTI crude, where we are 78, pushing 78 today.
Yeah.
There's been some talk about this whole move has been primarily a short squeeze because people were caught offside. Is there any way from Commitment of Traders Report or other, data to know whether this is strictly a short squeeze? Because that obviously is going to factor into inflation expectations at some, going forward.
Yeah, there's a little bit of a short squeeze, but I think a lot of it's just people turning more bullish on crude oil. As we went into the end of last year, a lot of the verbiage and reports were very pessimistic and negative and just giving how China was going and all that. But what we've seen in particular is U.S. crude oil inventories continue to get drawn down. And right now, part of the strength in oil is just this very cold weather, which, again, a lot of homes and businesses in the Northeast still use heating oil. So along with natural gas getting an uplift, oil's gotten a little bit of an uplift from this cold weather we're seeing here in the Northeast. Part of the headlines this morning was that the U.S. put on additional sanctions onto Russia. So again, it's trying to limit their exports of crude oil. And, China is still sort of a wild card here, but there's a little bit of short covering, but I think a lot of it is just, one, the inventory levels in the U.S. being drawn down and people getting nervous about that. And we'll see what goes on here. You and I were talking before. It's interesting because, when Trump takes office in 1 week, big thing he wants to target is reducing inflation. And the biggest up factor on inflation right now is energy prices. This is not good for Trump's agenda in reducing inflation. So we'll have to see how this all plays out. But it's a little short covering, but I think a lot of it is people just turning around their view here, just given where we're seeing inventories and everything play out here. So it's worth keeping an eye on. We're still constructive on the outlook for crude oil prices this year.
And can you give us an update on where OPEC Plus is with their containment of oil production, and where are we in refilling the special petroleum reserve as well?
Yeah, the strategic petroleum reserve is still pretty low, and so that's another factor. We need to refill that. Whether Trump decides to take that on at some point, we'll see, because that's certainly, refilling the SPR is not going to bring oil prices down. And in the prior administration, it released a lot of oil trying to keep prices low. They recently started to add some oil to the SPR, but it's still way below where it had previously been. And then what was the other part of your question there besides the SPR?
Where OPEC Plus is in terms
OPEC Plus, yeah. So they still have on the docket to begin increasing some of their production at the end of March. Now, we'll see whether that happens or not. It really depends on where oil prices are, because they've pushed that out twice now by 3 months each time. Just because oil prices were down in the 60s, mid to low 60s. So now that oil's up here 75, 80, and what their outlook is at the end of March will dictate whether or not they actually follow through and beginning to increase or put some of that oil back in the market at the end of March, or whether they push that out another 3 months. But our view has always been that OPEC likes the price up here around $70 to $80 a barrel. And so we'll see sort of what they see in their forecasts and where prices are and inventories around the globe, what's going on with China, as to whether they follow through and actually now putting some of that oil back into the market. But I don't think that they definitely don't want to see oil prices below $70 a barrel, in my opinion.
And finally, just to conclude, I mean, you obviously like CNQ. There are 2 or 3 other favorite names you've been buying.
Yeah, yeah. On the oil side, Diamondback and EOG. And EOG presented at the Goldman's conference last week. They're pretty good at their canned response to questions, so you really couldn't glean anything incrementally new from them. But that's one of the names I expect to have a good quarter, and a name that I continue to like. Diamondback's been a little bit weaker here, but it's the other name that I'd be looking to buy. So if you're looking at the oil side of things, CNQ, EOG, Diamondback.
Great.
So I know you own a couple of those, Charlie. So
I do. I restructured a lot of my portfolio in the fourth quarter towards energy.
So, yeah, I think that'll be a good move. I think that'll pay off this year. So
in general, I'll tell you, my bias is that anything that you drop on your foot and hurts is what I want to own. So a barrel of oil, if I drop that on my foot, it's going to hurt. A coil of copper, it's going to hurt. A bar of gold is going to hurt. So that's what I've been sort of reorganizing my portfolio towards those types of hard assets.
Yep. I understand it. So, well, good. Well, thanks everybody for dialing in this morning. We hope you enjoyed the show, and we'll be back again tomorrow morning.
Thanks, Bob.
Thank you. That was good, Charlie. That's a lot of good information. I always enjoy hearing everything.